Reserve Bank of New Zealand kicks off its easing cycle, cutting its official cash rate 25 basis points. Australia's jobs figures today may provide further clues on when the RBA might move. US July inflation comes in on target, and there's another will they won't they rate decision today in the Philippines. That's coming up in 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner analyses why the Reserve Bank of New Zealand's Monetary Policy Committee felt it was able to cut rates a full year ahead of its previously published forecasts.
I think it's probably best to think about their decision today in terms of a threshold being crossed, quite a binary kind of thing. It wasn't actually about necessarily changing their inflation forecasts a great deal.
But first, in 5 and 5 with ANZ, the RBNZ has started its easing cycle, cutting the official cash rate by 25 basis points to 5.25%. ANZ New Zealand Chief Economist Sharon Zollner says the move reflects what must be increased confidence at the RBNZ that the recession it wanted to engineer has weakened demand enough to ensure CPI inflation will return to its 1 to 3% target band this quarter, and then shift down to the 2% midpoint across 2025 and early 2026.
I think it's probably best to think about their decision today in terms of a threshold being crossed, quite a binary kind of thing. It wasn't actually about necessarily changing their inflation forecasts a great deal. In fact, their forecast for non-tradable inflation was much the same, but rather the confidence in those forecasts. And that message was reiterated at the press conference. They're now confident that although there are still some upside risks to inflation out there, the broad thrust of inflation has got some significant downward momentum and that they are going to get to target one way or another.
As of 4 a.m. Sydney Melbourne time, the New Zealand dollar was trading down 1.25% at 60.01 US cents. The Aussie dollar was down 0.44% at 66.02 US cents, and the Kiwi Aussie cross was down 0.78% at 90.91 Australian cents. Number 2. Sharon says the new forecasts released by the RBNZ yesterday imply 3 more cuts across its next 3 meetings, and for the OCR to settle at 3% by mid-2027.
Now that the Reserve Bank started cutting, the default has to be just simply a 25 basis point cut at each meeting, so that's what we've penciled in. But there are obviously risks on both sides of that. We would see them as balanced around that. On the one hand, we've seen some pretty significant global wobbles recently. Things seem to have calmed down, but that could rear its ugly head again and see cuts faster. On the other hand, the housing market, for example, could respond more vigorously than expected, and that could delay cuts. So we think the risks are balanced around our updated track. We still see the track going down to about 3.5% as before, just getting there a bit sooner because the Reserve Bank has started sooner.
And we'll have more from Sharon on the Reserve Bank's rationale for cutting in today's deep dive interview. Number 3. Global markets overnight were focused on US July CPI inflation. That came in, as expected, at 0.2% for the month. At 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.2%. ANZ head of G3 Economics Brian Martin says around 100 basis points of Fed rate cuts remain priced in for 3 meetings in 2024.
The headline year-on-year rate fell to 2.9%, and that was the lowest annual increase since March 21, and does really underscore the fact that the disinflation process in the US is underway, and that will add to confidence as we go through the third quarter that the renewed reduction in inflation pressures is sustainable and will contribute to growing confidence at the FOMC that they will be able to begin cutting interest rates soon. We expect the first 25 basis point rate cut to come in September.
Number 4. Australia's July jobs figures today will provide an extra clue as to when the Reserve Bank of Australia might cut rates. The market consensus is for the unemployment rate to stay at 4.1%. ANZ head of Australian economics Adam Boyton is expecting it to tick up to 4.2% as employment drops by 5,000.
Sitting behind that expectation of a fall in employment isn't a view that the labour market is deteriorating rapidly. Rather, it's an assessment on that part that the seasonal sorts of patterns we saw play out last year will play out again this year. So July last year also saw a soft employment print, and it looks like that was related to the timing of school holidays. We think that we'll see that again in July this year. It's just a view that we think there'll be a bit of statistical noise in this number, and then if we get that later today, we'll be expecting a strong employment outcome in August.
Number 5. There's another will they won't they rate review in the Philippines today. ANZ economist Arindam Chakraborty says while there has been speculation of a rate cut, economic data points to the central bank, the BSP, holding at 6.5%.
On the growth front, activity has remained resilient with a 6.3% year-on-year increase in Q2 GDP. Labour demand has lifted with the unemployment rate falling to an all-time low of 3.1% in June, while real wages grew steadily in the second quarter. So overall, we think the economy is robust enough for the BSP to keep the policy rate unchanged at its upcoming meeting and wait for inflation to ease further.
Arundam Chakraborty there. Now, in our bonus deep dive interview, ANZ New Zealand Chief Economist Sharon Zollner analyses how the Reserve Bank of New Zealand's Monetary Policy Committee felt it was able to cut rates yesterday, given it forecast in May it wouldn't need to cut until this time next year. She spoke to my colleague Alex Tarrant.
I think they're going to remain very much in data-dependent mode. At 5.25%, the official cash rate is still very much in restrictive territory. Of course, the first cut is the deepest. There is a binary kind of element to it. People who are considering borrowing, whether that's to buy a house or make an investment, will now have much more confidence that if they can handle today's interest rates, then they're good. So it is a big decision, but the pace of easing will be determined by the data from here. The Reserve Bank has taken a lot out of their near-term GDP forecast. They're expecting a 0.5% drop in Q2 and then another drop again in the September quarter. So in that light, the hurdle for upward data surprises is kind of lying on the ground at this point, I would say. So the market will be very keen to price cuts, quite aggressive cuts from here, but we would just caution that it will still depend very, very much on where the data goes from here.
What do you think has led to those dramatic revisions in the GDP forecasts? Because we've basically had the high-frequency data. Is it just dependent on that?
Yeah, so essentially the challenge with the data we've seen is that it is just sort of essentially 1 month of data in indicators that can be quite volatile month to month. But what was striking was how broad-based it was. It was everything from job ads to the performance of manufacturing index to the performance of services index seriously fell out of bed, to heavy traffic, to plane loadings, to, you name it, job ads, house sales, everything tanked in June. But what is interesting, we have seen a couple of signs of life in July. The heavy traffic, our own truckometer index, bounced back significantly in July. We've also seen the auction clearance rate for the Barfoot and Thompson, the real estate agent in Auckland, bouncing back quite a bit in the last couple of weeks. So it's an interesting one because this slowdown was deliberately caused by monetary policy. Now that's incredibly unusual. Normally, the recessions come about because of some negative income or confidence shock, a big shock to our commodity prices emanating from offshore or an earthquake or a pandemic or something like that. But this is a very unusual cycle. And so we're now going into an unusual set of rate cuts when there isn't some other accompanying big negative shock that's going to hold things back. So there is a possibility that everyone could be surprised by how quickly the economy rebounds in response to these rate cuts. That seems hard to envisage at the moment because the economy is clearly very weak and struggling, which is, of course, why the Reserve Bank felt comfortable cutting today. But there are still risks on both sides because this hasn't been a normal recession and this may not be a normal recovery.
Now, obviously in May, there wasn't an OCR cut forecast until this time next year, and the Reserve Bank actually in the press conference was forced to sort of defend what was called a mechanistic forecasting tool for the OCR track. Do you have any thoughts about that in terms of what it showed in May and the defence of it now?
I think the Reserve Bank would have to acknowledge that May was a step in the wrong direction. They made some very pessimistic assumptions, which we pointed out at the time that we thought that maybe they should have more confidence that inflation was going to keep falling, but they were very worried about some productivity data and they had just had a significant upside surprise on the non-tradable inflation. But I think it is risky for the Reserve Bank to dismiss their OCR track in particular because that is a very important signalling device for the market. So you can't sort of tell people, well, ignore what we said last time, but take what we're saying this time as gospel. There has to be some sort of consistency there. So I think probably the upshot is absolutely take note to what they are saying, but always be aware that they reserve the right to change their minds as the data keeps coming in.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 15th, the day after New Zealand's official cash rate started falling. Catch you tomorrow with those Australian jobs figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.